How do I close a Canadian subsidiary? Closing a Canadian subsidiary is not just a matter of stopping operations and walking away. The corporation exists as a legal person in its own right, and you have to bring its affairs to a clean, deliberate end. That means dealing with tax, creditors, employees, contracts, and filings in the right order. Done properly, you wind the company down, distribute whatever is left to the parent, and leave behind a neat paper trail. Done badly, you can face lingering tax questions, claims from creditors, and awkward surprises if you later try to re-enter the Canadian market. The easiest way to think about closing a subsidiary is in stages. Stop doing new business, clean up obligations, deal with assets and tax, and then legally dissolve the corporation. Stopping operations and freezing new obligations? The first informal step is to stop taking on new obligations. If you know you will close, you want to pause new long-term contracts, major purchases, and new hires. That does not mean you walk away from existing customers. It means you shift your mindset from growth to wind down. You also want to communicate with key stakeholders at the right time. Employees, major customers, landlords, and lenders should find out from you rather than through rumors. The timing and tone of those conversations matter, both for legal reasons and for your reputation as a cross-border player. Settling debts and contracts. Before you can realistically dissolve a subsidiary, you need to address its obligations. That includes paying trade creditors, dealing with lease terminations or assignments, handling severance or termination entitlements for employees, and resolving any outstanding disputes. In some cases, you may be able to assign contracts or assets to another member of your corporate group, but that should be done transparently and on commercial terms, not as a way to strip value out of reach of creditors. The goal is to avoid leaving behind a shell company that still owes people money. If creditors remain, formal insolvency tools may be required, but for many subsidiaries, a straightforward wind-up with negotiated exits is enough. Cleaning up tax accounts. On the tax side, you need to make final filings for corporate income tax, GST or HST, payroll, and any provincial accounts such as provincial sales tax or workers' compensation where they exist. That usually means filing returns up to the date operations stop, remitting any outstanding amounts, and requesting the closure of tax accounts once everything is reconciled. In the final income tax return, you deal with any remaining loss balances, recapture on depreciable assets, and possible deemed dispositions of property. If the subsidiary sells assets to the parent or to third parties as part of the wind down, those transactions may generate gains, losses, or sales tax consequences that belong in the last returns. You want to reach a point where tax authorities have no open questions and no open accounts in the subsidiary's name. Handling assets and distributions to the parent. As you wind down, you will decide what to do with the subsidiary's remaining assets. Inventory may be sold off, written down, or transferred. Equipment can be sold, scrapped, or moved to another part of your group. Intellectual property that sits in the subsidiary may need to be assigned back to the parent or another affiliate. Once debts and taxes are handled, any remaining net assets can generally be distributed to the parent as a return of capital, a dividend, or a mix, depending on how the structure was originally set up and what makes the most sense tax-wise. It is important to document those distributions properly in corporate minutes and accounting records, so everyone can see how you got from the subsidiary's opening balance sheet to the final zero. Legal dissolution and corporate filings. When the business is wrapped up and accounts are settled, you can move to formal dissolution. That involves filing dissolution documents in the jurisdiction where the subsidiary was incorporated and clearing any outstanding annual returns or corporate registry issues. If the company is extra-provincially registered in other provinces, you also need to withdraw or cancel those registrations. Once dissolution is accepted, the subsidiary ceases to exist as a legal person. At that point, you should not be seeing new filings or correspondence in its name. Any stray communications after dissolution need to be reviewed carefully because they may signal unfinished business you missed in the wind down. Why planning the exit matters. Closing a subsidiary is easier if you treat it as a planned project rather than as a reaction to a crisis. When you sequence the steps, you can manage communications, protect the parent, and avoid triggering unnecessary tax or legal risks. You also keep the option of returning to Canada later without having to explain a messy history to banks, regulators, and partners. Final thoughts. Closing a Canadian subsidiary is about more than filing a single form. You pause new activity, settle obligations, clean up tax accounts, deal with assets and distributions, and then formally dissolve the corporation and its extra-provincial registrations. If you approach it in that order, you end up with a clean exit instead of a trail of unresolved issues. If you want a more detailed checklist for planning a wind down, from first board decision to final dissolution filing, you can explore resources at www.theaccountingandtax.com. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.